Lovely to see you all. Good morning. It's wonderful to be back in Davos, and as usual, Davos has done that global capitalism thing of giving us a mot du jour already, and that's polycrisis. Which basically just means that what we all know, there's a lot of bad stuff out there that we're all having to negotiate. And of course, the theme of this panel is financial institutions innovating under pressure. And you're going to hear not so much from me, I hope, because we've got an enormous panel of really big names in finance as well. So I kind of want to hear from them. You really don't want to hear from me too much. Look, so we will have a look at some of the crises that will come up naturally in the conversation. We'll look at some of the financial innovation out there that is good, that is providing amazing opportunities for not only you, the global elite, because you are the global elite, but also for the world as well. But we also need to discuss briefly, I guess, at least the elephant in the room, and that is that financial innovation is not always for the greater good. It is not always actually for the good of markets. It's for the good of people who are selling the product, and doesn't necessarily, of course, mean we are moving to a better world, to a more stable financial market and a more stable economy as well. And of course, we're talking about products such as crypto as well, which may have its amazing opportunities, blockchain, which could be fantastic, but quite frankly, is unproving in many ways. And the people of El Salvador are suffering for that, perhaps at the moment as well. So look, the polycrises, I'll just go through it quick. You know these: war, inflation, rate spikes, energy crisis, cost of inflation, cost of borrowing, cost of living, stock markets, bond market concerns, climate change. Climate change was the top topic at Davos for many years, and now it's kind of, yeah, it's there, but it's one of many crises. Inequality growth as well, which I know at least one of our panel wants to talk about as well. So we'll address a lot of these and the benefits that financial innovation can bring, perhaps, to some of these, and indeed what financial innovation can't do as well. Now, we have got an amazing panel. I will just very, very briefly go through who we've got here on stage from right to left, I think I was told to do, actually. So let me just tell you who's on the right, on your right, my far left. Ronald P. O'Hanley, of course, Chairman and Chief Executive Officer at State Street USA International. Lovely to see you, sir. Thank you very much indeed for joining us. Next to him, we have Dan Schulman, who is President and CEO of PayPal USA. And Dan, just reminding us of how you're supposed to dress in Davos before we all put on our suits and ties. Rocking the cowboy boots there, Dan. Thank you very much indeed for that. Next to him on his right as well is Mark Suzman, who is the CEO of the Bill and Melinda Gates Foundation. We have Lynn Martin, who is the president of the NYSE. Nice to see you as well. And next to me on my left-hand side is Mohammed Al-Jadaan, His Excellency, who of course is the Minister of Finance for Saudi Arabia. So before you all get excited about innovation from the other four participants here on the panel, I want to start off with His Excellency, if I may, because guess what, financial innovators? You've got to work within the system. Otherwise, you put the system in peril. You've got to work with governments. You've got to work with regulators. And it is something you, sir, are very keen to point out, as indeed you were during the G20 presidency, which Saudi Arabia had in 2020. So why don't you start us off, sir?
Oh, thank you very much, and good morning, everyone. I will be very brief on a few points. One is there is obviously a legitimate concern and legitimate need, both at the private side, innovators, conventional financial institutions, but also disruptors. And there is also a genuine concern at the regulator's side, and both have legitimate concerns, and both needs to be understood and need to work together. I think the societies, the businesses are calling for more innovation. There are a lot of benefits for innovation. We have seen actually tremendous benefits to societies, to inclusiveness, to dealing with issues, dealing with risks from that actually innovation helps with. But at the same time, regulators need to be cautious. They are cautious by nature. They need to make sure that financial stability is not impacted. They need to ensure that risks are mitigated to the extent possible. So for that to work, you will need both. And then on the other side, I think conventional financial institutions, as possibly some of the headlines of this session is saying, are really rushing to innovate under pressure, because these challenging innovators are really bringing a new ways of doing business that these conventional institutions will need to deal with, will need to innovate to catch up, will need to make sure that they are not left behind. So that balance will need to play, and I think there will need to be this dialogue between private and public sector for this to work for the benefit of all.
Straight away, and I'll go there straight away, if you have the conventional banks and the conventional way of looking at things, and everyone's in a very happy world in their regulated world, does that push into another realm which is unregulated? We've talked about shadow banking for a very long time. Does it put shadow financial innovation into an unregulated world, which potentially then has risks for the rest of us?
Absolutely, and I think the regulators under the G20, if you recall, in 2020, when it was in Saudi Arabia, framing the regulatory function to deal with the digital era was part of the priorities, and this was carried through until today. There were a lot of initiatives under the G20 that has been taken by multilateral institutions to help deal with this. Obviously, you will need a space for innovators. You will need to provide, as regulators, sandbox environments for them to try in live operating function what they are doing and their innovation. But it will need to be regulated. Otherwise, it could actually pose a risk on financial stability, pose a risk on actually societies. And we have seen people losing a lot of money when you are not too careful with the regulatory framework.
Yeah, although those of you who have got Bitcoin, what did I say, 21,000 yesterday from 16? It's quite a rally off its lows. Lynn Martin, if we're going to see problems under the bonnet, we're probably going to see it via exchanges like the NYSE, because of the companies that you service, the companies that are on the exchange, the companies that look to go to the next stage on public markets as well after their financial innovation in the private sector has gone to a certain level. What do you see as the greatest problems at the moment, given the last couple of years we've gone through?
Well, I think just carrying on from what His Excellency said, I think the key there is to have guardrails. I think fair, transparent markets have been the reason why you haven't seen more systemic issues in the current market than you currently have. Take 2008, for example, when we had a variety of challenges, systemic issues in financial markets. What happened post-2008? The advent of central clearing. When you look at the credit default swap market, which is something that our parent company actually pioneered at ICE. Why you don't have that issue today is because you talk about the crypto markets. Those haven't been adopted by institutions. Why haven't they been adopted by institutions? Because there isn't the guardrails that have been telegraphed for other financial instruments. Requirements to go on exchange, requirements to be centrally cleared. Those models have been battle tested through multiple financial crisis. Buyer meets seller, seller meets buyer. There's a central counterparty that guarantees settlement. And if you look at the issues over the last few months, in particular with the FTX bankruptcy or whatever the case may be, there isn't a central counterparty that's ensuring someone is the buyer to every seller and the seller to every buyer to guarantee settlement. So I think the more traditional financial models, the financial structures, such as the exchanges, the clearinghouse, have shown to be, again, the beacons of transparency in challenging, in volatile markets.
OK, I'll push back a little bit. As a former derivatives trader,
sure.
I've relied on a central counterparty,
sure.
and I agree, the central counterparty party model works very, very well.
Yep.
But you've also got exotics out there. You've also got OTC out there, and there's a vast amount of transactions between State Street, I'm just saying State Street, it may be anyone else, and whoever it may well be, and whatever the clients, that are not central counterparted as well. And it's in this enormous
And to that point, I think the financial regulators have done a good job on the capital requirements when banks trade those more risky instruments that don't have a central exchange model or a central counterparty model to put up additional collateral, to treat differently on those bank balance sheets. I actually think State Street has been a perfect example of where financial innovation in a regulated market has worked well. I mean, they pioneered the ETF market 30 years ago, and you talk about an instrument that has added transparency to illiquid asset classes, particularly like the fixed income markets. I can't think of a better product than the ETF market.
I can't either, actually, and it has, I think, done what perhaps Mark and Dan will be looking at as well. It's opening it up to more people, opening up the equity market to bomb. I couldn't agree more. But this isn't just about me and Lynn. I will move on to the others. but Lynn, in terms of again, we talked about these non-regulated products as well on crypto. So we can bring them in then, even if there isn't a central counterparty, which kind of flies against what you told me. We need central counterparties, but we've proven in the financial system we don't need them if we have better regulation.
We need the regulators to tell us what the guideposts are, what the rules are, what the regulated framework is to bring them into more traditional structures, into more traditional ways of execution.
Brilliant. I'm going to move on. It's not, as I say, it's not just about us two chatting. I'm sorry, the idea is, by the way, ladies and gentlemen, that I'm going to run through a quick conversation with everyone, and then I'm hoping they're all going to just take it away and just argue amongst themselves. But near the end, if they do say something that you find fascinating, and they will, trust me, and they already have, please get involved, because again, you are, as I say, the global elite. It's up to you to justify the vast amount of money you've spent coming here as well. So let me move on to Mark as well. I think Lynn made a great point actually about ETFs, and it is one of the areas that has democratized share trading and all kinds of products as well. Having said that, is it still a rich West tool? Are there so many more levels we need to go through, hoops we need to go through, and things we need to do in order to bring the world of finance at perhaps a more basic level to the world, Mark?
Yeah, so maybe let me start with a long-term framework and then some short-term challenges. In the long-term framework, financial innovation writ large, if properly democratized, actually we believe can be an enabling platform unlike any other in terms of bringing prosperity across the planet, including to the world's very poorest people. And that is particularly through the expansion of digital payment systems. One of the silver linings of the pandemic was actually a big expansion of digital payment systems, often government-to-person digital payment systems, and those which bring people in, whether they're smallholder farmers across Africa or South Asia, or whether they're new banking systems or others across many of those parts of the world. But what you need is a combined framework, and some of these short-term lessons are you need a regulatory framework which is robust and actually helps build trust within the community. You need, and this is something that may be a little bit more up for debate but by some of my co-panelists, but we think really fully interoperable digital payment systems at the national and global level, because that's actually the platform, whether you're a small trader or a large trader, that becomes a huge public good. And we actually, as the Gates Foundation, invest in an initiative called Motor Loop, which actually tries to provide some of those interoperable digital trading platforms as a public good. And that you need then functional other digital tools like digital identity and related things which can all come in. Now, we all know those. We're aware of them. Most of us will use them. But actually, the potential to bring those down into the many billions of people across the planet is very high. It's probably the highest leverage intervention we have. And so over a 3, 5, 10-year period, we're incredibly optimistic about that potential to actually drive innovation and development. But in the short term, what we're also facing, and it was in the WEF opening report and a number of the other gloomy reports coming from the IMF and the World Bank and others, is a short to medium term kind of fiscal crisis that is facing 1/3 of the world is likely to be in recession in the coming year. Many, again, of the lower and lower middle income countries don't have the fiscal and other firepower to do enough meeting debt crises. And they've been a form of innovation of different kinds of debt products, including, rather than simply having multilateral debt products, there's been a lot of things from private actors actually entering frontier markets and running things with tools like, including ETFs and related issues, but also new entrants, particularly China, coming in at significant scale. And what that led to, it helped lead to a lot of very positive momentum. At a time of crisis now, it's very complicated to reset and to try and put liquidity back into the system. And so in countries, for example, just one country, Zambia, which recently had a debt restructuring arrangement, which was one that China and others get. There were 17 different Chinese entities which turned out to be lending to them, who are also negotiating with traditional financial providers from New York who want their share of us when you're doing a debt negotiation. And so you need some innovation at that as well. And that will require some fundamental innovation, which is on the global agenda right now in the G20, the G7, about can you actually provide some new tools to unlock multilateral development finance. And so innovation in the multilateral space, we've seen some of it in the IMF's special drawing rights. We need some of it in multilateral development banks like the World Bank to actually potentially expand their lending portfolio and use their AAA credit rating. And so that combination of dealing with the short-term crisis, because it is a very real acute crisis that is affecting literally billions of people across the planet, but then trying to take the promise as you deal with these risks and issues, and we've got the warning signs that we've seen from the sort of crypto and blockchain and related issues that you raised, but knowing that there is still a very positive long-term trajectory which can actually be transformative for the planet.
There's a lot you've packed in there, from SDRs to global payment system. But let me just go back on that initial point. And I think it was one thing that you said could really transform. And this is a fully, and I hate this word, interoperable global payment system. What is the barrier to a global interoperable, I've said it twice correctly now, global payment system?
Well, there are multiple barriers, and it'll be very interesting to see what my colleagues on the panel say. Some of it is at a national level. You often just have lots of competing incumbents, obviously, particularly in the traditional banking system, who resist and are concerned about things. When you have non-payment banks, or you look at countries like India, which were pioneers in terms of allowing non-payment banks and digital transfer and assets and things, but you've got to keep the regulatory framework there. That becomes challenging at the national level. They're creating global systems which often are national but haven't figured out the global interoperability. And really, one of the challenges is for private players, very logically, when they're coming in, they're seeking to maximize profit. That will tend to take you to your traditional sort of more elite companies, individuals, high net worth individuals. And so you do need some degree of public sector, global and national public sector subsidy to make sure that these infrastructure and guardrails is being set up in a way that also brings in many of the poorer parts of the countries and helps develop things like credit systems that will meet, small-scale women entrepreneurs. And that is a long-term business opportunity, but it's not a natural one for the private sector to enter on its own unless pathways are built through entities like ours, like philanthropies, through regional and multilateral development banks and other places.
And like working with governments such as Saudi as well. Dan Schulman, I have so many questions for you. Lovely line. I was born with social activism in my DNA, you told the NYT as well at some stage. But I know that PayPal, and there's a lot of things that have already been said that I know you want to come back on, but PayPal has been thinking about this topic for a long time. I went and had a look at PayPal newsroom topics, and the third wave of financial tech innovation is something that you've got your employees and your ecosystem to have a real big think about, including the impact of blockchain, quantum computing, more mobile adoption globally as well. And apologies for everyone over this side. I'm just naturally going this way, but I haven't forgotten about you all. So just give us a round robin of where one of the biggest innovators in the world of payment systems over the last couple of decades, PayPal, where we think we're at now and what we need to do and what we need to be concerned about.
Well, I think if you take a couple steps backwards and just look at the big picture, I agree with what was just said. I mean, you have at least 2 billion people in the world who are outside the financial system today. You probably have at least another 2 billion that are poorly served by it. And what I mean by that is they pay very high fees or interest rate for services that, the more wealthy pay much less for. In a country like the US, you have 2 out of every 3 adults struggling to make ends meet at the end of the month right now. So I would say we have a good financial system, one that has integrity behind it, but I don't think it's doing the job that it needs to do, which is being an inclusive economy that brings everybody in together. And I think, of course, we need safeguards, and of course there needs to be public-private partnership and partnerships and feedback loops between the private and the public sector to put responsible innovation and guardrails around that. But I've seen many a collapse of what should be both in the traditional banking system as well as in the unregulated banking system. And I think things are moving so quickly right now that it is very difficult for regulators, very difficult for private companies to keep up. And this idea that banks are sort of these lumbering incumbents and Silicon Valley or other startups are these innovative, that's a false narrative. I really believe that. I think that banks are tech companies, just like tech companies are financial service players as well. We're all tech companies right now. And you have innovation happening at rapid speed right now, whether it be AI, which is just ready to make its debut and take off, whether it's new forms of accessibility, whether that's 5G or other forms of technology, new forms of compute power. The next 5 to 10 years, certainly you'll have the beginnings of quantum. Combine those all together, and you will redefine the financial system. It will happen. And the question really is, how do we do this in a way that is safe and secure and inclusive? There are things like blockchain, like distributed ledgers, that get a bad name because they're conflated with crypto. Crypto, the coins that are traded, are risky, assets that are being traded. Like, you don't know whether Bitcoin will be 21,000 or 40,000 or 5,000 tomorrow. You have no idea. It's sentiment that makes that happen. But the underlying technology, despite all of the disruption in FTX and others, has performed perfectly. The hashes are still performing. And the promise of a distributed ledger is that it can be faster and cheaper, so that you can do and settle transactions instantaneously with no middlemen, bringing the cost way down. And that's an important thing, because the more we can do things faster and less expensively, the more people we can bring in. The financial system for the last 20 years has had stubbornly a take rate of about 2%. Despite the scale that's gone on, the take rate hasn't come down. And what's worse is that the take rate for those who have less is substantially higher. It can be 5 to 10% for a transaction that for those who have more can be 50 basis points or less. And so we need to, in fact, I think it's the moonshot of the financial services industry, writ large, and regulators, to figure out how do we create an inclusive economy, because I believe that an inclusive economy is a strong economy.
Brilliant. I'll get to Ronald next as well on this. Ronald, you provided me some great bullets as well, and a lot of it is actually the financial crisis, the COVID crisis, the concern about war, and all the other crises and the economic worries we have is actually leaving people with a lesser attitude to risk. They don't want to take on so much risk. They haven't got so much liquidity to invest in technology as well. And it's leading to a situation where there are some real dangers for the progress of financial innovation going forward. Do you just want to give us a round robin of your thoughts to this, representing, dare I say it, the whole banking sector?
Yeah, sure. So if you think about the last 15 years since the financial crisis, the overriding theme of regulators has been to reduce, if not eliminate, systemic risk. And they'll never say it that way, but that really is what it's about. If you think about 2008, there was a vast concentration of risk. And all of the regulation since then has been about how do we distribute that risk. Some of it has been around stress testing and raising capital requirements. But a lot of it is around sets of activities and innovators that have come in to, when it became too expensive for banks after this, given the capital requirements to do things, now it's gone out into an innovative form. So consider credit. In the United States, back around the time of the financial crisis, 80% of all mortgages were originated by a bank. Today it's 20%. Last year and the year before, over half of all credit originated in the United States was done through some kind of private credit. So it's a distribution of risk. The challenge has been, and by the way, that is a very good thing if you think about it, because what we found in 2008, it was this concentration of risk, lots of leverage that wasn't understood, that led to everybody blames it on Lehman. It was more than just one institution, but a series of institutions that actually caused not just a global financial crisis, but an incredible global recession. So there's been a single-minded focus on that. The challenge is that you've got a lot of this innovation that's occurred. Lynn has referred to some of it, and it's not that the regulators have ignored it, but they've more or less said, if it's not going to create systemic risk, then I'm not going to really focus on it at this point. And true, it's not creating systemic risk. I mean, FTX happened, and somewhere between 2 and 3 trillion of value was destroyed, and yet we're all here, right? We didn't cancel because of FTX. So, but that doesn't mean that people weren't harmed. I mean, the last number I heard, there's 1 million investors or participants that were harmed. So part of this is there needs to be a change in regulatory mindset that, yes, systemic risk and avoiding it is very important, but there's other things out there. And how are we going to kind of keep up with this technology? The point on payments is a really important point when it comes to inclusion. And I think if you talk to most banks, they want to support this. They recognize that this isn't the business we're in, so I'm speaking for others. They recognize that the traditional bricks and mortar branch, somebody coming in, that doesn't make sense. It's not going to work in most parts of the developing world. But we've then got to support that. We've got to have the banks competing with the technology innovators. In some cases, it's the technology innovators that are providing some of that underlying technology to the banks. Last, what I would say on this is the other thing to think about as you're thinking about this innovation is money has more than one purpose. We talk about it a lot in terms of payments. So everybody says, well, why not have all of these, whether it's a cryptocurrency or a central bank digital currency? But money and monetary policy also is used as a way to regulate economies. And that is actually a real dilemma for the central banks today. How do we think about a central bank digital currency and monetary policy? And what are we going to do about money supply and things like that? So part of what we need to think about as we move to this next level is that money has actually more than one purpose.
Okay, brilliant. Dan, just jump in. And I was going to say, from this point onwards, it's going to be a bit of a smorgasbord of people jumping in on different things. So, Dan, you come in, but then I do want to ask His Excellency what he thinks about everything he's heard from the private sector. Yeah. So, Dan, take it away.
I do think it's important not to conflate cryptocurrencies and CBDCs, stablecoins, and DLT. Those 4 things are they are linked in some ways, but they're very, very different. And I think things like CBDCs and interoperability, these things are all kind of linked together. I think when the West weaponized SWIFT in sanctions against Russia, I think large parts of the world, whether it be China, India, Middle East, South America, saw that capability and have said to themselves, do I want to be subject possibly to that happening? And so this interoperability, and I think we need to think about it through CBDCs, stablecoins might be an answer to that, is quite an interesting topic. as these neutral third-party money transmitters became weaponized. And I think you're seeing state actors begin to look at CBDCs and begin to think about maybe that is a way of lessening the primacy of the US dollar as the global currency reserve. And so I think there's a lot to be thought about from a geopolitical perspective, a technology perspective, and an inclusivity perspective as we talk about these things.
Lynn, you're nodding. I just want to bring His Excellency in first, and then I'll come to you after, Melinda. Everything you've heard from this brilliant panel so far, actually, no, let me put it another way. Everything I've heard worries me intently. You've got Ronald talking about, oh yeah, we lost $2 to $3 trillion conservatively on crypto, on the crypto winter, but we kind of got away with it. We're all here.
Billion, he said, not trillion.
Trillion, it is trillion.
Yeah.
Billion.
No, it is
million.
No, it's trillion.
Billion. Yeah. Trillion.
Trillion.
Trillion, yeah, exactly. Trillion. But we all kind of got away with it, you know? So that's worrying that so much money can be lost. And yet we're all here because, that's okay. It wasn't regulated. We're not so worried about it. That was a near miss as far as I'm concerned.
I will tell you, and I think they are the experts, it's, very, very interesting insights. But I really believe that we haven't seen still the real risk of these innovations. If we are talking about one incident and the loss of a number with 12 zeros behind, beside it, to me, I think this is just one incident that shows how risky it is and will actually trigger a lot of thinking among regulators of what needs to be done. And thankfully, in this incident, I think the risk, as mentioned, the risk was quite widely distributed, but it is also selfish from the central bank's point of view and the traditional institutions' point of view to say that, because it's not them who lost the money, it's the public. So the wider public who have not been really protected enough, at least. To me, I think the risk is even wider. To me I think both the innovators, the private side, whether it is traditional banks or new technology firms that are providing financial services, will need to think about basic things. How are we going to deal with anti-money laundering? How are we going to deal with terrorism financing, illicit activities that use these technologies actually to circumvent the regulatory framework and the government role?
They don't want it to be regulated.
Well, I think the problem is you will come back and say, where was the government, okay, when something really bad happens? And we do want that to happen. I think both sides does not want that to happen. Number 4, when we talk about CBDCs and similar, even government-sponsored currencies, I think one also will need to think about privacy. You cannot have your cake and eat it. You just can't have that. So the minute you go with CBDC, the minute you go with government-sponsored currencies, you will need to realize that part of the compromise is that you will compromise on privacy, because that will provide a lot of data to whoever is holding that data registry. And you could go even extreme and think about what can be done with CBDC. For me, I think CBDC in at least developing nations will be a fantastic tool to provide, for example, social safety net. So if I wanted to provide my citizens with certain support, I would actually flag that CBDC to say you can only buy milk, rice, oil. You cannot go and buy a new iPhone. You cannot go and, so you can actually use it, but then you need to recognize that it comes with also another side of risk, which is there is some privacy issues that you need to be careful with. So bottom line, I think there is no perfect solution. And people need to realize that if they don't work within a very reasonable framework of actually collaborating with regulators, the risks that we have seen so far are very small, considering what could happen.
We'll come to Lynn next. Mark, why don't you have a little think about what's just been said, because you want financial innovation for developing worlds, for frontier markets, for populations who are underbanked. But I don't know if this is the right kind of innovation that's going to solve some of those issues. But we'll come to Lynn first, and then maybe we'll come to you on that afterwards.
I think a couple of the points that have been made on the panel, some of the things that Dan in particular said around every company is really a technology company. It's something that I like to say too, because every company is using technology to further their business. And there very much is a convergence now between the traditional financial institutions and the technology companies, mainly because, as Dan had put it, the underlying technology that underpinned the crypto market is good. I mean, if you look at DLT, if you look at, the way you can employ some of the technology to make things like settlement, equity settlement, make equity issuance more efficient, it's a great thing. It's absolutely something we should leverage as an institution. But for whatever reason, that gets, the blockchains gets a little bit of a bad name because of the challenges with
But not every exchange thinks blockchain's the way forward now, do they?
Not every
Did I
time.
see the Australians as having a little bit of a think about their adoption of blockchain on their exchanges?
Can't really comment on their specific implementation of blockchain technology, but I know, for example, a T+2 settlement in the US market in this day and age is completely inefficient for a security. So I think there is a way now that some of the technologies have been adopted and used to really make processes much more efficient. That efficiency will enable a lot of the other topics.
And we're making a very distinct point here. Processes, it can really aid. It can really support, and actually can support transparency about the risks of the system.
Exactly, and then that opens up some of the challenges to, furthering the financial systems, giving more access
So
to
that's
folks.
not as exciting for some people. Under the bonnet, the changes are amazing, but actually some of the products that Dan and everyone's been talking about here, they're a little riskier for the world as well, because now if tech is bank and bank is tech, it's hard to delineate. Mark, why don't you come in, and then we'll get Ronald and Dan on this one, and then I'll open it up to you all. So have a little think if you want to get involved. If not, I'll just carry on.
Yeah, well, I really want to build on His Excellency's point about, the attributed digital currencies, which may be, central bank issued or other tools, actually we believe can be an incredibly powerful lubricant for the economy that actually brings in inclusion for the poor. It both potentially significantly reduces corruption, because you can actually track when, think of it, one of the largest sets of payments are government payments that go to support poor people, both whether it might be direct grant payments, the kind of things we saw during COVID for support across the rich and low and middle income countries, whether it might be subsidized forms of public-private credit that are there to try and generate entrepreneur systems. And it does exactly what Dan was talking about, that currently, remember, the poor pay a much higher margin than the rich do for any financial product they access, whether it's a remittance, whether it's a loan, whether it's a basic transaction. That's just a fundamental injustice. And these digital currency tools, if you can create the framework of that interoperability that you do want, in this case it's the best of the intermingling of the technology firms, including some of the mobile phone services and providers with the banking infrastructure, I think there is a very positive framework that can be adequately regulated and needs to be adequate, because these people need those security even more. But that potential is very real. It's the biggest platform we have that can actually help sort of re-energize the kind of big global growth and poverty reduction we've seen.
I don't know how that happened. I mean, the Kenyans were doing mobile phone payments long before the rest of us as well. They were early adopters of this technology. To hear that a lot of the emerging world, developing world, is paying more for the services is just a crime against humanity. Ronald, I want to come to you about some financial products. And I hear what you and Lynn are saying about, and to a certain degree, His Excellency saying the point that we're in a better place to look at the problems that financial innovation has created because of the experiences we had in 2008, 2010. But there are still financial innovation products, forget about crypto, that are mainstream products that are being sold by financial institutions that are just not right for the client, that are not progress as well. I think one point that your your team provided me was talking about, for instance, LDI, liability-driven investments. And a lot of these products are just not suitable for the client. So it's a great example of financial innovation, once again, not actually being for the greater good.
Yeah, I mean, I'm not sure that I would agree that LDI wasn't a good product. And by the way,
the way it was sold was a very bad product.
No, maybe. But I mean, remember what LDI was about. LDI was about pension systems really not able to sustain themselves. So what they were trying to do is recognize they've got long-term obligations to pensioners. How do we put assets against them to do that? The challenge there wasn't the product. The challenge there was leverage, right? And this is the problem. I mean, I would venture, including ourselves, and we're on both sides of this, right? We actually manage these products and we provide collateral services for them. We had no idea how much leverage was in the system. And this is the problem.
Despite all the technology, Ronald, you didn't have an idea of how much leverage was in the system.
You can have a very good product, but when you start to add leverage to it, that is where the problem becomes. So again, this comes back to that a lot of innovation happens. It gets ahead of regulation. It looks like it makes sense, and then it makes sense until it doesn't. In this case, you know, you had a budget crisis in the UK.
I'm going to leave it there for the moment. Does anyone want to ask a question? This lady here, I'm going to get one or two quick. I'm just very aware of the time, and I've got to be back on set in 20 minutes for another interview. So if you state who you are and just open your question up.
Hi, Venetia Bell, Young Global Leader from Gulf International Bank. I would love to hear from the panel what you think the next wave of innovation will be around sustainable finance. We've heard a lot already about financial inclusion, but climate finance, for example, nature-based solutions, what are your views?
Right, who wants to pick that one up?
I'm happy to.
Ronald.
Yeah, I think the biggest innovation that's required in sustainable finance is how do you take a number of small projects, aggregate them such that large institutional investors can actually deploy capital. The challenge that we have now is many of these projects are actually quite small. And if you think about an institutional investor, you know, who's sitting in some developed world and who's got to deploy capital in the tens, 20s, hundreds of millions of dollars. So I think the real innovation here is around aggregation and how do we aggregate these projects. On the nature side, I think there's a lot of interest in how to do that and a recognition that whether it's biodiversity or preserving kind of carbon capture, natural carbon capture. So there it's thinking about, and this is a bad word too, you know, how in some way do you, quote, securitize that so that you can actually make that investable?
A quick answer from Lynn. We've got a lot of ladies going to ask a question, then I'm going to have to wrap it up after that because WEF will kill me if I ruin their whole schedule this early in the day. Lynn.
And just to piggyback on what Ron said, you know, one of the things we've been working on is the development of these things called natural asset companies, which provide the ability for someone to invest in preservation of landscapes. We've been actually in deep dialogue with the SEC and are hoping to bring these products out to market so that, for example, government of Costa Rica, the government of Gabon, governments can actually create these products which will allow investing, but those products would have to file quarterly financial statements. So there'll be all the transparencies of being a quote-unquote listed product alongside the ability for folks to invest in the sustainable finance side of the business.
Lady at the back, quick question if we could, rather than one of mine, which goes on too long.
Thank you very much. I'm the Minister of Environment of the Republic of Rwanda. I wanted to know from the bank, the financial institution, how do you motivate people who want to invest, I mean, who have green investment? How do you differentiate people who do investment, casual investment, and green investment, if really we want to improve the state of this world? Thank you.
Thank you. Your Excellency, do you want to pick on that? How do we motivate populations in their investment in these areas?
I think definitely there are a lot of actually products, including in the technology sphere, that deals with green investment. But definitely the governments and the regulators have a role to play. There are also limitations on what the government and regulators can do to incentivize green investment. But I have seen governments where they have actually provided some tax relief on green investments, certain tax reliefs for investors on green investments that can actually help, particularly small ones.
Mark, did you want to come back on this? Is your wheelhouse?
Yeah, so well, I actually just like to make a plug for a sector that is clean and green, but not often talked about in the climate discussion, which is the so-called climate adaptation side, which is essentially food security, and food security writ large, where you can get more efficient water use, more efficient fertilizer use, investment in drought and resilient seeds and livestock. These are actually big, tangible investments. Over time, they can be aggregated into very large investable tools, and that's an area where we think there's actually enormous opportunity that provides great short-term benefit for the planet. It's linked to the wider climate issues.
I'm going to get one more question to Dan, because I'm very aware that I haven't asked you as many questions as the others. Dan, I also spoke to you about what PayPal is doing and looking at this next wave of innovation as well. What were the conclusions so far? I know it's a longer process. What's the most exciting area where you think can make the biggest difference on a global basis and to the current financial architecture?
Well, we don't really have a lot of time. So one thing I do want to do is pile on to what His Excellency said. I think the most important word in the financial services industry is trust. That is what our brands are based on. That is what regulators wish to see in the system. And trust comes from two things. It comes from security, making sure that your transactions will be secure. So it's foundational that you have AML, that you have BSA, that all of the things. It's just foundational. You can't do it without that. And the second thing that there needs to be is a partnership hand in hand with regulators, because you can't have any one company, whether it be banks or fintech or technology companies going into the market, not working hand in hand with regulators, because there needs to be those safeguards and that trust that goes on. And you can do all sorts of innovation within those guardrails. You can put out new forms of lending that allow people in banking deserts to get working capital to grow their businesses, that allow people to take out loans that have never been able to do that, to be able to support themselves. So I don't think it is the services itself that are either inherently risky or not. It is the framework in which you look at them.
You heard they're clapping, so they're already well behaved. I'm going to finish this off with literally one word or two word answers from all of you as well. The technology in financial innovation you are most excited about. I'm going to ignore the negative stuff for this last question. We're going to end on an optimistic note. Ronald O'Hanley, what are you most excited about in financial innovation? Just a couple of word answer.
AI, because I think that AI is going to propel real productivity in services, including financial services.
Dan Schulman.
AI.
OK, that was easy. Mark Suzman.
Well, actually, AI with the digital
come on, guys. We need a
No,
bit of...
it's true, though, because, frankly, AI can actually provide you a lot of those things for credit risks for even the lowest income in ways that existing institutions struggle to do.
Lynn, I'm relying on you to say something else.
AI.
Oh, man.
Improves transparency.
Your Excellency.
I will skip. They are the technology guys. They will not talk about it.
Look, it's been a real pleasure seeing you all this morning. Thank you very much indeed. Let me just tell you who we had on this brilliant panel. We had Ronald O'Hanley, thank you, sir. Dan Schulman, lovely to meet you, sir. Mark Suzman, excellent. Lynn Martin, lovely. And Your Excellency, Mohammed Al-Jadaan, thank you very much indeed. Let's give a round of applause to our panel.